So you're scrolling online and you see these terms everywhere. Index funds, mutual funds, hedge funds, ETFs. They get thrown around like everybody just knows what they are. But let's be real, it can get super confusing, right? Well, that's exactly what we're going to do in this explainer. We're going to cut right through all that noise. We're going to break these things down in a really simple, practical way so you can finally get what they are, how they work, and, most importantly, who they're actually for. So here's how we're going to tackle this. First, we'll start with the absolute basics. Then we'll walk through each type of fund one by one, and we'll wrap it all up with a simple way to think about which is which. Okay, let's get into it. Before we get into all the different flavors, we have to understand the main ingredient. What even is a Funyun in the first place? Okay, think of it this way. You and your friends want to throw an absolutely epic birthday party. Now, instead of one person footing the whole bill, everyone chips in some cash. With that big pool of money, you can afford way more stuff, right? Food, drinks, maybe even a DJ, the whole shebang. A fund is the exact same idea. A whole bunch of investors pool their money together so they can buy a big, diverse portfolio of assets. It's basically teamwork for your money. All right, with that foundation set, let's jump into the big one. The one you probably hear about constantly, especially if you follow any finance stuff online. The index fund. Now, to get what an index fund is, you first have to get what an index is. And honestly, the best analogy is a scoreboard. An index is just a pre-made list of companies that represents a piece of the market. It's the scoreboard for that sector. So an index fund's entire job, it's just to copy that scoreboard. That's it. No genius stock picking, no guesswork, just copy the list. And I guarantee you've heard of the big ones. The S&P 500, it just tracks the 500 biggest companies in the US. The NASDAQ, that's heavy on the big tech companies like Apple and Microsoft. And the Dow Jones, that's a list of 30 huge established American companies. An index fund just buys a little piece of all the companies on one of those lists. It's really that straightforward. So this right here is the absolutely crucial takeaway. Index funds are passively managed. There's no person, no team of experts sitting around a table arguing about which stocks to buy or sell. The whole thing is on autopilot. It just mirrors the index. And this simple fact is precisely why they're so popular, because it leads to one massive advantage. And that advantage is rock bottom fees. Think about it. Since you're not paying for a fund manager's salary and their whole research team, the costs are incredibly low. We're talking an annual fee, what they call an expense ratio, as low as 0.02%. So on a $1,000 investment, that's just 20 cents for the whole year. Over the long run, that is a huge, huge deal. Okay, one last little quirk to know about index funds. You can't trade them all day long like a regular stock. You put in your order to buy or sell, say, at 11 in the morning, but the trade doesn't actually go through until after the market closes at 4 p.m. Everybody who traded that day gets the exact same closing price. Now, for a long-term investor, this is no big deal, but it's a really important difference. So that's the passive, hands-off approach. But what if you do want an expert at the wheel, someone who is actively trying to beat the market? Well, that brings us to the classic alternative, the mutual fund. And this table here just nails the difference. While an index fund is passive and its only goal is to match how the market is doing, a mutual fund is actively managed. You've got a fund manager, and their whole job is to pick investments that they believe will beat the market. You're paying for their supposed expertise. But of course, that expertise comes at a price. As you can see, the expense ratios for mutual funds are way higher, usually somewhere between 0.5% and 1.5%. Now, that might not sound like a lot, but trust me, over decades of investing, that difference can eat up a huge chunk of your returns. And funny enough, history shows most active managers actually fail to consistently beat their simple, low-cost index fund competitors. Okay, so we've got passive index funds and active mutual funds. Now, let's step into a completely different universe, a much more exclusive, aggressive, and frankly risky one, the hedge fund. Yeah. Hedge funds are not playing the same game as everyone else. They use some really complex and high-risk strategies to try and get massive returns. They do things like short selling, which is literally betting that a stock's price is going to go down. They use leverage, which is just investing with a ton of borrowed money to amplify their bets. And they use all sorts of complex things called derivatives. This is the high-stakes table. And because these strategies are so risky, you could lose everything. Hedge funds aren't just open to the public. You have to be what's called an accredited investor, which basically means you have a really high income or a high net worth. It's a rule designed to protect everyday people from taking on way too much risk. And the fees? The fees are in a whole other league. Hedge funds are famous for what's called the 2 and 20 model. That's a 2% management fee every single year, even if they lose money, plus they take a 20% cut of any profits they make. To justify that kind of fee, they have to be swinging for the fences and aiming for absolutely extraordinary returns. All right, let's come back from that high roller world to something a lot more accessible. This brings us to the newest and maybe the most flexible player in the game, the exchange-traded fund, or ETF for short. Probably the easiest way to think about an ETF is like a hybrid. It's got the diversification of a fund, meaning it holds a whole basket of different stocks or bonds, but it trades on a stock exchange just like a single share of Apple or Tesla. It really tries to combine the best features of both worlds. And this right here, this is the game changer. Remember how we said index funds and mutual funds only trade once a day at the closing price? Well, ETFs don't have that rule. You can buy and sell them anytime the market is open, and their prices update second by second. This gives you a ton more flexibility and control. And most ETFs are passively managed, just like index funds, which means they also have those super low fees. So, wow, we have covered a lot of ground. Passive, active, exclusive, hybrid. Let's put all these pieces together now in a simple framework, so you can really see where each one fits. This really brings it all home. Look, if you're a long-term, hands-off investor who just wants low costs and wide diversification, well, index funds and ETFs are usually the go-to. If you're an investor who really believes a specific manager has a secret sauce and you're willing to pay for that expertise, then you might look at a mutual fund. And if you're a high net worth investor who is comfortable with big risks for potentially huge rewards, that's when hedge funds even enter the conversation. And there you have it. The fog is lifted, right? Those are the core differences between the big types of investment funds. Now, this isn't financial advice, of course, but it is a foundation of knowledge. The most important thing is just understanding what each tool was designed to do. Now that you've got the building blocks, you're in a much better position to continue your own learning journey.